Okay, so there are a couple of things upon re-listening to my recording that I wanted to clear up. I didn't quite like the way that I said that. So, first of all, it is the access to capital, the ability to borrow from the future and spend today, that is the Cantillon effect. And when I use that word exploit, I'm not saying that in any sort of civil rights context. I'm purely like game theory. This is the reality. How do I exploit it for personal gain, whatever. No morals or ethics being projected onto that. Especially in an inflationary environment where inflation is greater than the interest rate. Secondly, it is the access to foreign markets that enables the Triffin effect exploit. Furthermore, about John Maynard Keynes, the way it was said earlier, it kind of made it sound like Keynes was against Bretton Woods. That completely false. He was instrumental to it. He had a lot to say about it. But specifically, what I was getting at was the Bancor, his proposition for the global reserve currency as opposed to the dollar. And ironically, in my opinion, it was actually the Americans who insisted on using the dollar as the reserve currency. I also didn't make this adequately clear in the end that we could see both deflationary and inflationary effects at the same time because the money is not adequately flowing through all areas of the economy, right? So when households have less money, then and chasing the same goods, prices drop. That's a deflationary affect, right? But at the same time, if the Fed is printing more and more money and only certain corporations, certain entities have access to that money, then you have inflationary effects in only those areas of the economy that have that much money. For example, you're not going to see Jeff Bezos say, "Oh, I've got an extra $100 million. Let's buy 1 billion gallons of milk." Of course not, right? That would rot. It's perishable. He's not going to spend his money on milk. He's going to spend it on equities. So you shouldn't expect to see that type of inflation on groceries. You should see it in equities, and vice versa, right? So the point I meant to drive home further is that you can have both deflation and inflation in the same economy at the same time, and that's a big problem, and it prevents any sort of monetary policy from fixing it, right? Uh, yeah, so that's it. There was one other thing I wanted to drive home why monetary policy is feeble in this situation, because no matter how low you make that interest rate, you could set it to zero, you could make it negative, but the Federal Reserve cannot compel the banks to loan to people. And that's why they're completely ineffective and impotent at making the money supply really expand into these areas of the economy. Okay, thanks for joining me, Steve. You're here to ask questions, make sure that I'm making my points well, and just give me somebody to talk to, so I'm not talking to myself. So, I had emailed you a couple days ago saying, hey, these are the things that the presentation is generally going to be about. Are there any of these things that you don't fully understand? And you responded the difference between monetary fiscal policy and bond yields. So the key with the bond yields is just that it moves inversely to price. Um, and the way to understand that, so if I'm the government, I'm issuing a bond. It's basically like, hey, I'll give you $100 next year. What will the market give me for that? And if I have really good credit and everyone trusts me, then they may say, oh, well, I'm willing to give you, $90 for that $100 IOU. And that would give you a yield of 10%, right? But let's say my credit wasn't that good. I say, hey, I'm selling the same 100 face value 1 year bond, but people don't really trust me. They're only willing to pay $83, demanding a higher yield when it comes due next year. So that just shows you how the inverse relationship, right?
Yep.
Does that
Yep.
make
Okay.
sense?
That makes sense.
Cool.
Yeah.
And monetary policy is the money supply, right? Monetary. And fiscal policy, whoops, is how you spend that money.
Okay.
So it either gets spent. hmm, Okay, so it either gets spent by the government or a company that's borrowing the money. But when it comes to policy, we're talking about the government. Okay? So
Okay.
I've got a few points that I'm going to make. These are generally things that I find people don't fully respect about what's going on. Some of them I was not taught. These are things that I kind of found in my own research, trying to understand the problems, and I think that they're more important than ever in understanding the economic situation that we are in right now, um, especially with COVID. Yep, foreseeable, real effects. Okay. Here are a few educational resources. So after this, I'll give you some of these. I think these are very helpful in terms of education. George Gammon's really good at breaking down a lot of these more esoteric economic concepts, and Real Vision Finance is great for news. They're like a freemium type of service. They have free videos on YouTube, and they don't sugarcoat it. They talk the way that they think. It's not some BS. It's real finance people who just talking about how they see things going on. Wolf Street and Zero Hedge, these are news sources, and they tend to be better sources for financial economic news than other places.
I've
So I
heard of
can
Zero Hedge before.
Yeah, yeah. So I can share with you those links. Um, there was one thing there was one thing I wanted you to take my word on because I'm not going to break it down for you, but after this is done, I can give you a really good video that'll break it down. But the assumption that I want you to make and just trust me on is that when money is created, it has to be loaned into existence. Okay?
Okay. Yeah. Okay. I can
Okay.
I can
So,
deal with that.
So for now, and I realize that might be kind of a leap, but for now, just trust me. And then I'm going to make my
It's,
points, and then there are other people who have already made great videos breaking that down. There's no way I'm going to do a better job than they've already done at explaining that. So I'm just going to refer you to some of those videos afterwards, okay? All right. So two of the principal, I don't know what to call them, principles, I suppose, the Cantillon Effect and Triffin's Dilemma. The Cantillon Effect generally states that even within a single economy, right, using a unified money supply, not all dollars are equal, especially when extreme inflationary environments or deflationary environments. Not all dollars have the same spending value, right? And the way to think about that, to make sense of that, is you understand that if you raise the supply of dollars, suddenly there are more dollars chasing the same amount of goods. It makes sense that prices would rise, and that would be inflation, right? That makes sense to you?
yeah.
Okay, so what the Cantillon effect is saying is it takes time for that new money to actually disperse into the economy and manifest in a change in price. So that first person that spends that first dollar after it's created, before he spends it, the inflation hasn't happened yet, right? The money isn't a
Right.
part of the economy yet. So if I just create $1,000 out of thin air, that's $1,000 that I get to spend at the value of the dollar that it is right now. Does that make sense? So
Yeah.
then
Yeah. So okay.
then after it disperses into the real economy, then it gets less purchasing power because then you've diluted the supply. So whoever that person or company or entity is that gets to spend those dollars first, they get more marginal value. They get more purchasing power from each unit of dollars than you or me at the end of the day. Okay? And that's really
Yep.
important during inflationary markets. And the stronger, the faster the rate of inflation, the more pronounced this effect is, right? And the other one is the Cantillon or Triffin's dilemma. So there's this guy, Robert Triffin, who I think it was 1960. He addressed Congress about the problems he foresaw in using the dollar as the global reserve currency. So As you may know, the dollar is the global reserve currency. It's basically the most trusted. It's used by most people to denominate their debts and contracts all around the world. And what Triffin was saying, and he's not even the first person to say this, but he is the
Mhm.
namesake. What he was saying is that it creates a conflict of interest for the monetary policymakers. There's a conflict of interest between serving the needs of the globe, the global economy, versus the domestic economy, and that there are going to be discrepancies versus between what's in the best interest for the domestic American economy and what's in the best interest for the global economy. And that over time, this discrepancy is going to become more and more severe and apparent. And it's really important to understand that because that's what's been happening for about 100 years now, just slowly trickling.
So the
What's
U.S. is
hmm?
printing money, right? And then, well,
Yeah,
kind
well,
of to tie it into the other thing, like they're using the early dollars to outsource and import things, while the dollar is the most effective.
Yeah, well, that could be. That's certainly
Okay.
happening, right? Like these, the corporations are borrowing money with their bonds, and then they get to spend it because they're multinational corporations. You and I, we don't have as much of the same luxury as purchasing labor from Vietnam, right? We can
Right.
purchase
Yeah.
goods. We do reap the benefit of having cheaper commodities prices as a result of that overseas business, but we're not getting the Cantillon effect. And then Triffin's dilemma,
Gotcha.
kind of parallel, is it's generally just there's a conflict of interest in monetary policy that's brought about by using the same currency domestically and internationally. And if you look at this, and specifically what Triffin was saying is exactly what happens. I have a graph here. Notice manufacturing is this dashed blue line, just bleeding out continuously since Bretton Woods, which is when the dollar became the world's reserve currency. 1971, that's Nixon's shock. That's when we removed the convertibility to gold. So that's a pivotal year to remember. Um, this is the manufacturing, the dashed blue line, and it's just basically bleeding out. And there's no way to change that. And I'll explain why exactly that's happening. But first, let me show you this bottom blue line. This is our trade deficit, right? So when this line is below zero, you see which one I'm talking about,
Yep.
the solid blue. So when it's below zero, that means we're in a net exporting country. So we are producing goods like steel or coffee, whatever it is, and we are exporting it to other countries. And when it's above zero, that means we're net importing. So we are importing more goods than we are exporting. And the implication there, the reciprocal of that means that we are exporting dollars. When this is above zero, then we are spending more dollars outside the US than we are receiving coming in through that trade.
Yeah.
And this is actually by design, and it's very predictable, and it has to do with this Triffin dilemma. Because if you want the whole world to use the dollar as their currency to denominate all their contracts and such, well, then they need some supply of dollars, don't they? If they don't have any dollars to use, then they're not going to use your currency. So you have to net supply them with more dollars than they are paying you. And so this is one thing that Triffin predicted would happen. You'd be forced to run this deficit uh, trade. And the other part of it is the manufacturing, as we see bleeding out. And that's
Right.
because of the relative power of the dollar, right? So if you or I were living in Vietnam or we're living in Mexico or we're living in some other country, um, their currencies are cheaper compared to the dollar. Because the dollar is the global reserve currency, it basically creates that demand, which raises the relative value of that currency. But us, you and me here inside the United States, we're not just trading in the dollar. We have to pay our mortgage in the dollar, we pay our rent, we pay our groceries in dollars, we buy gasoline in dollars. Our whole livelihoods are in dollars. Whereas the laborers in Vietnam don't have that same problem. So it's not possible for a laborer in the United States to compete against somebody in Vietnam because our cost of living is higher. And because of that, it's entirely predictable that if you have this problem, if you use the same currency for your international uh, standard as you do your domestic standard, you're going to have this problem where your own domestic manufacturing cannot compete against foreign domestic manufacturing. And that's exactly what we see. And there's no reversing it. And we see, what is it being made up in? This is in GDP, right? Or percent GDP. For the most part, for the last 100 years, it's all being made up in the financial sector, right? This is finance, insurance, real estate, rental, leasing, because they're the ones that get to exploit the most this international trade and this free market activity between different currencies. So that's the first thing. Triffin's dilemma results in this. Okay. Oh, the other thing I wanted to establish real quick, maybe you already know it. The velocity of money. Are you familiar with this?
Um, it might be worth
It's
refreshing my
basically
mind.
it's basically just that when the same unit of monetary base is spent multiple times in one, we'll call it a cycle, then then it's effectively mediated more than 100% of its value, right? So for example, let's say an auto manufacturer, oh, he gets paid $100 one week. Okay, so then that's $100 that's been produced, and there's 100
Mhm.
units of monetary base. But then he goes and then he gives that $100 to his child's daycare center, right? So now there's $200 of value being mediated with the same 100 units of base, right? And
Yep.
then the daycare worker turns around and she gets her nails done and spends that $100. Now there's $300 of value being mediated by $100, right? So that's generally that's what velocity means. So when this number is really high, that means that each unit of monetary base is being spent over and over and over again, and it's mediating more value per unit. And this is important to understand, especially in the context of coronavirus lockdowns, as we will see in a second.
So, like, the opposite of that situation would be if you gave somebody $100 and they just parked it in their savings account.
Yeah, exactly. Well, usually if you did park it in your savings account, what would happen is that the bank would then try to loan it out again. That's the fractional reserve system, which I think you said you have a general understanding of what the fractional reserve system is. So, right.
Yeah.
So
I
they
think that's like keeping like a certain amount in cash versus loaning the
Yeah,
rest out.
yeah, exactly.
Okay.
So if you save the $100 and they're supposed to have some sort of minimum reserve requirement, like say hypothetically it were 10%, then they have to keep 10% of your money there to prevent like a run on the banks or something. And another 90% they can loan out back into the economy. And if they did that, if they loaned out all that money over and over, that would increase velocity as well.
Got it.
Um, but as we'll see, there's a problem that comes up when uh, the banks cannot loan out that money. And that's basically what we're going to cover later on. But first, going back to velocity, and forgive the scales here. See how I line this up? 1980, 1980, 1990, 90. So these are
Yep.
lined up, even though the
Okay.
pictures are kind of off. Here is the history of velocity of M1 compared to the M1 monetary stock. And they don't want us using this anymore. They want us using the M2. But for the principles I'm using, it doesn't matter. All I'm trying to show you is that, look, the velocity was rising, rising, rising until what year? 2008 is when it crashed and it never really recovered. And then here's coronavirus lockdowns. Poof, right? What number is this? This is practically one. All right, so for a velocity of money to be one, that's essentially pure entropy, right? That's each unit of monetary base gets spent once and then dies, right? So this is not a healthy thing to see. And really what I wanted to show, graphing it against the monetary stock, is this is what most people look to when they're talking about, quantitative easing. The Fed needs to print all of this money. It's adding all this to the balance sheet to increase the monetary supply. But what people leave out talking about that is the relative velocity. So you can see how they're really just trying to make up for this crush in velocity. Because if they didn't, guess what would happen? Like you would have, I don't know how much, I was going to say millions, but who knows how much it is. You're going to have an overwhelming proportion of your economy that cannot pay bills because you have more outstanding debt than you do money to spend, right? If velocity is going down, you still have outstanding debts. You still have the student loans, you still have the mortgages, you still have the renters, but now the money's not moving. Guess what's going to happen? They have to increase the monetary base in order to make up for this, or else you're going to have deflation. When people don't have enough money to spend on the things that they need to buy, that's when things really get bad because then they have to start making choices. Oh, am I gonna pay my rent or am I gonna eat? And once that starts happening, then it all starts breaking down because you're choosing then to not provide income to somebody else down the road. And we have a whole lot, a lot of these mortgages are very much collateralized in the banking industry. And if everyone around the country suddenly isn't paying their mortgages, then that has systemic effects. So when the Fed knows, when they say, "Oh, we're going to lock down," well, I know that velocity is going to get crushed by that, and I need to make up for it somehow. And the only thing they can do as the Federal Reserve regulating money supply, monetary policy, is this. They can add to their balance sheet by buying Treasury bonds, and I think that they actually expanded it to include other types of assets, but that's another conversation for another day. But all they can really do is add a whole bunch to their balance sheet so that the member banks are flush with cash, right? But what's important to know is that this money, this isn't getting into the hands of the people who need it to spend on their rent, to buy groceries with. And all of these people, they're out of work, right? And they already have the household debt right now is higher than it's ever been. So the American people are already loaded up on debt, and now they don't have a job, right? So how do you get money where it's needed to go is the problem when all the Fed can really do is provide money to its own member banks. And that's why you saw these stimulus checks going out was exactly because of this problem right here. Um, what else do I have down here? Oh, I have a little bit. I was talking
So
about
for as
bonds.
far as
Yeah,
like the member banks go,
yeah.
so like the Fed, gives them a bunch of money. What do they usually do with like
They try
are
to
they using
loan it
that
out.
to
They
try and
try
loan
to
it out?
loan it.
Okay,
Yeah, so
gotcha.
the Federal Reserve adds to its balance sheet, and effectively, they don't exactly give cash to the banks, but you can kind of think of it that way. They provide banks what it's basically collateral so that the banks can make new loans to people, right? But at the end of the
Are they like they're buying assets from them? Is that what you mentioned?
so the Fed is buying assets. It's buying treasury
Got
bonds from the U.S. preferably, or it might be buying commercial paper if it's
got
high quality. But then all of this money that they're effectively quote unquote printing, it's actually
hmm
just increasing the supply within the member banks, and then it's up to the member banks to be able to loan it out somehow into the real economy in order to serve as a median for transacting value, right? But if nobody in the country is credit worthy because they're already maxed out on debt and now they don't have a job, then guess what? They're not credit worthy. And so this money never actually gets to them. It cannot be loaned into them. Make
gotcha.
sense? So all of
Yep.
this new money that they're printing is just being loaned wherever it can be, which is the only institutions that are allowed to stay in business. The multinationals, you got the FANG stocks and those types of things that actually stay in business. They're the only ones that can turn a profit. It's not going to go to the mom and pop shop down the street because they're closed, right? The bank is still going to operate in its own interest. It wants to make a return on its loans, so it's not going to loan to somebody that's unemployed. Make sense?
Yep. Yeah.
All right. Then I have a couple of slides about bond rates. So I asked you about the risk-free rate in the email, right? And you understood what the risk-free rate is. Basically, the Treasury bonds are considered the ultimate secure asset, right? The government's not going to default on its debts, and therefore the risk-free rate should be the Treasury bills. Usually, I think they like to look at it like a year out. There are obviously different maturities, different durations.
Yep.
But one thing I just wanted to point out how strange it was is to see. So what I'm showing here, Treasury bill rates. So this is government debt, 4-week bank discount rate, and these are always annualized, right? No matter what the maturity is, they're always quoted in annualized terms. So this is 5 basis points, right? And then you go and you look at the commercial paper, and look at this on Friday, July 2nd, 4 basis points, 30-day commercial paper, 4-week commercial paper, same time period, 5 basis points. That's not supposed to happen. So that tells you there's something weird going on in the bond market. And even more than that, if you look at the rate of inflation that we've had the last year, ever since Corona, and they've been issuing these stimulus checks. Obviously, you're creating inflation there. If you account for inflation, the real return on these bonds is negative, and yet everyone's buying them, or not everyone, but the money markets are buying them. So that's kind of a mystery. I'm hearing a lot of people talk about this, like, how does this make sense? I don't know, but there's something artificial going on, right? Um,
Yeah.
and it probably has to do with, like I was saying before, the Fed, it doesn't have enough highly secure uh, bonds to buy to add to its balance sheet. So I don't have a news article to bring up for you right here, but I remember right when in March 2020 they started talking about, oh, we might buy other assets too, and I don't know if they ever actually did or which ones they did, but there is a dearth of treasury bonds available to the banks. And also relevant to this whole phenomenon is what's it called? Basel 3. Have you heard of Basel 3?
I don't think so.
So Basel 3 goes back to 2008 during the whole toxic mortgages and everything. And they decided after that there was like this world accord, and okay, we're all going to do better at capitalizing our accounts. We're going to keep more secure capital on our balance sheet so that this type of thing doesn't happen again, because they overestimated the value of those mortgages, right? So in that name, all the banks basically declared, oh, we're going to raise these capital requirements, and now in the future you have to have a certain amount of what's called tier one capital, right? So there are more stringent asset requirements for their balance sheets. But if you look at the history since 2008, they have just continuously kicked the can down the road as far as honoring those requirements, and they still haven't finished it. I think, if I'm not mistaken, the American banks actually have made those requirements, but the European banks have not, and they keep postponing the requirements. So since 2008, 2009, over 10 years now, they've just been kicking down this requirement to have a certain amount of uh, of secure assets on their balance sheet. And
Interesting. Okay.
yeah, yeah, it is interesting. And I think
Yeah.
that's part of what explains this phenomenon, right? There is not enough of this high confidence secure debt out there circulating in the free market. And going back to the quantitative easing, I haven't really broken down what quantitative easing is for you yet, but basically what it is, the Fed is buying the debt off the market, right? So it's going onto the Fed's balance sheet instead of circulating in the market. And is this yes, the reverse repos. Do you know what repo is and reverse repos?
Mm.
So, uh,
Yeah, let's just start from the beginning.
yeah, so a repo is short for repurchase agreements.
Mhm.
So basically, pretend you and me, we're both banks, right? Um, I need a little bit of liquidity. I need some cash. I'm good for it, buddy. Let me give you, my car just for the night. You give me, $10,000 and I'll pay it back to you tomorrow morning plus interest, right? So
Yeah.
it's a quick overnight type of thing. I just need quick liquidity, and so you'll have my car for like 12 hours and I'll have the cash and then we'll swap back. Okay? Because we agree to repurchase it. And a reverse repo is the opposite of that, right? So I've got the cash, but I want the asset.
Okay.
So these banks, they're going to the Federal Reserve. So in the example I gave you, it was between you and me, and we're both banks. But what this is showing is between the Federal Reserve, the New York Fed, I suppose, and member banks. And it's not only member banks. I think this includes other investors like Fidelity and those types of investment banks. Um, but basically, why this is important, and it supports what we were talking about with the bonds here. There's not enough high secure assets, so they're basically. So I'm one of these banks. Okay, I don't have enough secure assets on my balance sheet to meet whatever requirements, right? I need to meet this requirement at a certain hour, and I've got all this extra cash because of all of the quantitative easing going on, but I don't have enough treasuries because of all the quantitative easing going on. The Fed took it all. So I'm going to make a reverse repo agreement with them to kind of get those assets back on my books and balance that out. And what else is significant? What do I have here? Okay, don't worry about that. And the other thing that's important to understand about that is that these banks are receiving interest on excess reserves already. So the interest on excess reserves is something they made up in 2008, and it gives the banks interest on money that they're just sitting on doing nothing with at all, right? And the reason that makes sense is because they want some sort of floor interest rate. It's one of the tools that the Fed uses to make sure that the interest rates stay within a certain range. So if I'm paying these banks a minimum, I think it's 15 basis points right now. If I'm paying you 15 basis points to do nothing, then you're certainly never going to loan it out for less than 15 basis points, right? That's basically the idea here. But what's important to, is it not on here? So there is the interest rate that they're getting on these reserves. Maybe I didn't put it in here, but the interest rates they're getting on these excess reserves on these repo agreements is less than the excess reserves. Um, and I don't have it on here, but
Okay.
that makes this even more significant because it's not the member banks that are doing. They're not doing it to make money,
So they're
right?
doing it just to comply
Well, either it,
to.
yeah, well, they're doing it because they need more secure assets on their books to comply with regulations, or it's not the member banks that are behind or responsible for all of this, these repos.
Gotcha.
1 year Treasury, yeah, I guess that's the risk-free rate right now, 7 basis points. 1 year corporate bond spot rate. Oh, so this is just, I was just showing you how this phenomenon is only on the short end of the yield curve. It's not as you go further out, it gets more and more normal. That's all this is showing. Oh, the CPI. That's a conversation to have. So the CPI, where do I have this? I break down. Yeah, we'll talk about that in a second. I've already talked a little bit about quantitative easing. I asked you to assume for me that money enters until it's loaned into existence. Yeah, I've already basically said this stuff. And then this is just a
Right.
picture of the stock market over the same period of time. So this is June 2020 to June 2021. You see the stock market increasing 30%. So that's the best return in the financial markets as far as I can tell. That's accessible to people. So everybody's basically just funneling all their money into the same place, and it becomes a self-fulfilling prophecy. I can't make money in the bond market if there are negative real yields, right? If CPI is greater than the return on bonds, why am I going to buy bonds? I'm not. I'm just going to buy stocks or I'm going to buy other things. So I think that's part of why we see the stock market rallying so much here.
Mhm.
The bias of inflation. So we're talking about the CPI again. The CPI is a measure of inflation, stands for the Consumer Price Index, and it's made up of a bunch of different goods. It's like a basket of things that normal people use, right? So think of stuff that you buy on a day-to-day or a week-to-week basis, right? You got to go grocery shopping, you put gas in your car, maybe you get an oil change, you pay your mortgage, you do all those types of things that they're trying to keep track of the cost of living for an average person. And they break these down city by city, and they also have just a countrywide aggregate called the Consumer Price Index. And
Right.
that's the standard by which we measure inflation. But what the point is that I'm trying to make is that this way of measuring inflation is not perfect. It has problems. And the reason it has problems goes back to Triffin's paradox, because a lot of these goods that we're using to measure inflation are being bought from overseas producers.
Right.
So, what do I have here? Oh, yeah. So before I show you that, let me show you this. So here is the CPI kind of broken down into different sections. So you got like computers and TVs, you got softwares, cell phone. These are all different things that average people might spend money on, right? And what you see in the top in the red, those are things that have gotten more expensive over the years since over the last 20 years. And in the blue, these are the things that have gotten cheaper. And so these two things tend to counterbalance one another, right? So what
Right.
you'll find if you're looking at the CPI, as long as your computers are getting cheaper and cheaper, you won't notice that your healthcare is getting more and more expensive. As long as
Right.
your cotton clothes coming from Vietnam get cheaper and cheaper, you won't notice your college tuition getting more expensive. And
Right.
so
Okay.
they know this and they use this to to create that bias CPI figure, right? And
Got it.
that's what I was referring to here. So what are the things that cannot be outsourced to other countries? Education, college education, you can't send that to a factory in Vietnam. Your healthcare, housing, childcare, right? What are the things that can be outsourced? Food, like coffee especially, your fabrics, electronics coming from China, Taiwan, what have you. And
Yeah.
I think you can imagine just in your own life, you've seen this discrepancy. The things that we cannot outsource to other countries, those things are
Hmm.
getting more and more expensive, way faster. And then these consumable things are getting cheaper and cheaper. And it kind of keeps people complacent and keeps people from realizing what's really going on and what the real rate of inflation is. Okay, so I wanted to talk about comparative advantage in the context of Triffin's paradox and globalized trade. So obviously, when we encourage free trade internationally, you're gonna get lower prices because you have a more competitive labor market. You can get cheaper labor. You can get access to places like Mexico, like Vietnam, that I've been using, and they can produce things for cheaper than you can do with American labor. And that doesn't necessarily mean that they have a comparative advantage. So this is a concept that I think every student in economics or finance or anything in business this is going to be driven into them like freshman year. Comparative advantage. That globalized trade increases comparative advantage, and everybody wins because we get better produced products at cheaper prices. And this is where it starts to get a little bit political. So we don't have to, and I don't want to make it partisan, right? So I think all of this is pretty nonpartisan. I think this is just flat an economic fact that there's a problem in our doctrine of comparative advantage. If the net effect is that the United States cannot produce its own goods, that's not a good thing. And I don't care if it makes it cheaper, right? If you're detracting from our national sovereignty, if we can't produce our own steel, like that's a problem, and it makes us beholden to foreign countries.
Right. And like the slide 20 clearly shows that there's
Oh,
it's a trend that sort of doesn't stop. So it needs to be made up for in other sectors, which is where and I don't see like the easy way to reverse this, right? Like
yeah.
how do you stop hidden inflation?
Yeah, well,
Or
excellent
like
question. So I'm gonna get into an idea down here. Um,
okay.
we just said that, yeah, and then especially I haven't even touched on this, but this is according to the Department of Labor, goods produced by forced labor. So there are a lot of countries in the
Mhm,
world that still use literal slave labor, and
mhm,
how can you compete against that? Even if there wasn't this Triffin's paradox and this discrepancy of the cost of living between America and these countries, you can't compete
mhm.
with literal slavery. It's not possible, right?
Right.
And it's
Yep.
a lot. It's a lot of countries. Okay, and this isn't
Hmm.
my list. This is the U.S. Department of Labor from 2020. I can show you the
Hmm.
documents for that. Okay, and I would challenge anybody to look at their shirt right now and tell me their shirt is not made in one of these countries.
Right.
It almost certainly is, right?
Yeah.
Oh, I've got a bunch of quotes. We don't have to read through all the quotes, but basically, these are a bunch of founding fathers who talk about tariffs.
Hmm.
And this is that idea that I was talking about before, that I was alluding to. So
Hmm.
here's George Washington. Do you want me to read all these?
That's okay. I mean, if you want to, can you send me the slides or I can
Yeah.
just look back at
But
them later.
what I would like to point out, if you take my word on it, they're all pro-tariff, all these guys.
Sure.
And the people that are talking, okay, George Washington, Thomas Jefferson, Andrew Jackson, Abe Lincoln. What do these people have in
Hmm.
common? They're all put on your money, right? All the people that they put on your money, right? It's kind of rich. And
Yeah.
here's a history of the Federal Reserve. 1913, that's when the Federal Reserve in its modern form was created. I think way back when there was like there was a short Federal Reserve and then it was destroyed by Andrew Jackson and then they came back. And then they came
Okay.
back. Yeah. And so I just wanted to point out that like during the majority of the American history, we did not have any income tax. We didn't have any payroll tax, right? 100% nearly of the federal government's income was from tariffs, is from taxing imports from other countries into the United States. And then somehow something happened where suddenly the federal government is more worried about taxing their own people, taxing their own production, than they are about maintaining manufacturing health in our country, right? And I don't know how you argue against that, right? Something changed right here where they decided, hey, let's start taxing our own people instead of the rest of the world. Especially right here, this is the end of World War II. This is Bretton Woods, right? Where we were the most dominant. military and economic power on the face of the earth. This is where the dollar became the world standard because we were the only country whose currency was really stable. So it kind of made sense in that way. But I'm not going to pontificate too much about that. I just wanted to point out the phenomenon. Here's a breakdown on the share of federal revenue. It only goes back to 1935. This graph went all the way back 1700s, right? So 1935 is about right here. So for this whole graph, income tax and payroll tax is a thing. And it's showing how even in just the last 100 years, our politicians seem more and more concerned with raising taxes on the working class than they are about corporate income taxes or uh, taxing imports from other countries. And it all goes back to the Triffin's paradox because they know that they want to run a trade deficit. That's what they want. They want to export more dollars than they import. They want to import their goods and services. That's the whole global monetary system. That's what it's built on. And as long as the American people are getting that cheap coffee and cheap t-shirts and all of this and that, they won't notice that their real economy that produces real stuff is getting undermined in front of them.
Right.
Uh,
Hmm.
so here's what I see going on. We're going to see at least one of these things. If we do nothing at all, if people don't stop and understand all this stuff, we're going to have one or both of these things. We're going to have this is what I see really soon, UBI, and this goes back to the problem of velocity, right? Remember I was talking about the stimulus checks being given straight to the people, and it makes sense because you can't loan to them because they're not credit worthy, but we also can't employ them because there aren't enough manufacturing jobs that they can do, and you're mandating that they stay home anyway. So I see this as an inevitability, right? They're going to come out with this in one way or another, whether they call it UBI or not. They're going to start giving money straight to people in one way or another, and I think they just don't want to call it what it is because that'll spook the market. Because as soon as they call it by its name, everyone will know, yeah, inflation is here to stay. This is not transitory.
Yeah.
And the other side of that coin, if uh, if the government doesn't do anything, if it doesn't spend, if it doesn't uh, give money straight to the people, then we're actually going to see deflationary problems because people do not have enough money to spend on the things that they need. And you're going to see mass homelessness. And the only way forward, especially in consideration of the Cantillon effect, when it's only these massive multinational corporations that can take advantage of the inflation that get that relative value. They're the only ones that can take advantage of the economies of scale, not you or me. They're the only ones that can take advantage of the difference in value between countries, right? So more and more, it's going to be made up by these corporations, right? So what I'm thinking here is you're going to have fewer and fewer companies offering more and more things. So like right now, the way it works, oh, you get a job at Apple, great, I'll pay you 70K a year. And then you take that money and you spend it on what you want. You spend some of it on rent, you spend some of it on clothes, what have you. The way I see it going down in the future, if there's less and less money, is Apple will basically say, "Hey, yeah, we'll employ you, and instead of giving you dollars, we're gonna hook you up with an Apple brand apartment complex where everyone that lives there also works at Apple,
Sure.
right? And then we'll pay you some Apple bucks that you can spend at the Apple store on Apple
Right.
brand groceries, you know, and they can make up for that lack of liquidity with their economy of
Right.
scale
Yeah.
that
They have.
right, because they're the only ones that can
Yeah.
do that. Okay, one last thing here. Why UBI I see as inevitable. You've got all of these different actors with various motives that all converge upon a single motive here. So the banking industry wants more T-bills to add to their balance sheet, as indicated by the irrational bond yields. The Fed wants more government spending because they themselves cannot force the banks to loan out money and make that money circulate. The government can spend it right into the economy via fiscal policy. So they want that. The public always wants cash. Why not? They don't understand the consequences. And politicians, of course, may see it as a way to buy votes. Hey, vote for me, and I'll give you money in your pocket. So you've got all of these different actors who all stand to benefit from increased government spending directly into the economy. And I'm not, spinning this as, oh, it's a good thing to have UBI or a bad thing to have UBI. I'm just saying I think it's going to happen because of these evidences.